Is it possible to progress without taking risk? A research-based perspective on risk, growth, and financial outcomes. The idea of moving forward without taking risk is appealing. In investing, business, and even career decisions, many people ask, can I grow without exposure to risk? Research suggests a nuanced answer. You can reduce risk. You can manage risk. But eliminating risk entirely means limiting growth. 1. Risk and return are structurally linked. Modern portfolio theory, developed by Harry Markowitz, formalized a core principle. Expected return increases with risk exposure. In simplified terms, cash low volatility, low return. Bonds moderate risk, moderate return. Equities higher volatility, higher expected return. Without taking some form of risk, returns are generally constrained to inflation-level growth. 2. The illusion of no risk. Avoiding visible risk does not eliminate hidden risk. For example, holding only cash avoids market volatility, but introduces inflation risk. Periods of high inflation, such as the 1970s in the United States, significantly eroded purchasing power even for conservative savers. What feels safe may silently lose value. 3. Risk versus volatility. They are not the same. Behavioral finance research, notably by Daniel Kahneman, shows that people often equate volatility with danger. But volatility equals price fluctuations. Risk equals probability of permanent loss. Short-term price movement is uncomfortable. Permanent capital destruction is harmful. Avoiding volatility at all costs can lead to missing long-term compounding. 4. Progress requires exposure, but not recklessness. Economic growth, entrepreneurship, and innovation all require uncertainty tolerance. For example, starting a business involves capital risk. Investing in equities involves market risk. Changing careers involves income risk. However, risk can be structured and controlled through diversification, position sizing, time horizon extension, emergency reserves, asset allocation strategies. Risk managed is not equal to risk eliminated. 5. The cost of zero risk. If an investor completely avoids risk, returns may not outpace inflation. Purchasing power may decline. Financial independence becomes harder. In long-term market history, broad exposure through the S&P 500 equity risk has historically been rewarded over multi-decade periods, but only for those willing to tolerate volatility. No risk often means no drawdowns, but also no meaningful compounding. Conclusion: progress without any risk is largely unrealistic in economic systems built on uncertainty. A more precise statement would be, growth requires exposure to uncertainty. The key is not avoiding risk, but managing it intelligently. The real question is not, can I avoid risk? But, what level of risk is aligned with my goals, timeline, and resilience?